Okay, folks, so as we head towards the end of the year, I want to talk about my top 5 stocks for buy, holding, and then forgetting about in 2022. You may be surprised at my picks. And the only thing that I ask before we get into this is that you hit that ravishing like button, and also don't forget to subscribe either. If you were to choose 5 stocks for 2022, they'd have to fit certain criteria. You would want international market exposure, you would want both big and small tech exposure. You'd want consumer spending exposure, something that protects against inflation but also benefits from interest rate spikes. You'd also want something that has long-term potential but also balances out with the market condition that we're going to have next year. And I'm about to tell you the top 5 right now, but keep in mind that I couldn't choose a lot of our early stage favorite growth companies for the very simple reason that they're not buy, hold, and forget about type of plays. If you have an early stage company, you have to follow through with it quarter over quarter. Mara, lovely Mara, takes up a lot of time and attention. Whereas the ones on this list, I believe folks can just buy now and then forget about them through 2022, and they're still going to do very well. But anyways, let's go ahead and get into it. So the first one is Disney. Ticker symbol DIS. Price-wise, Disney has been a disaster this year. The overall large cap market did very, very well, but Disney has been floundering since February. For Disney, it's quite simply been no cat and mouse game, going from highs at 203 to 142 at recent lows. And not only is that the case, but throughout 2020, it recovered and then broke out massively, expecting a hot 2021. But now, at the end of 2021, it's wiped away nearly all of the pandemic-era gains. Why? Well, Disney's caught between 2 problems. One is that their streaming service Disney Plus had extremely high expectations, and they are falling a little bit short of those expectations, at least in the present. That said, what drives streaming platforms is 100% the content they're introducing. You get 1 or 2 hit shows, and all of a sudden your growth numbers double. Disney Plus has a lot of planned content that they're going to release in 2022, so I'm very, very bullish on that segment. The other problem that they have is that their parks have been a little bit slower to come back than maybe investors would have wanted. And that is despite 2021, of course, doubling 2020's revenue. But keep in mind that Disney's theme parks are all around the world, and there have been a lot of rolling lockdowns and travel restrictions and overall COVID-related fear that just quite simply hasn't gone away this year. But still, one can envision that the long-term trajectory of these COVID problems and lower attendance for Disney parks go away 2022 and 2023. And if so, trends from this previous quarterly report suggest that customers that are coming back are spending 30% more than they did in the same time periods pre-pandemic in 2019, which means that when you do get attendance in full swing, all of these people are spending 30% more on average. Now, maybe over time that starts to normalize a little bit more downward, but still, if they're spending more on average and Disney starts hiking the prices a little bit, all of a sudden you got a lot of revenue that hasn't been present this year or last year, all of a sudden massively cascading into the bottom line of Disney in 2022 and 2023. And this was the most lucrative segment for Disney pre-pandemic. So big deal. That said, Disney is like investing in an entertainment ETF. They have so many balls in so many different courts that the NBA would blush. And you could see that blushing on ESPN, which Disney owns. Tidal Max made a great infographic showing the many companies and segments that Disney has stakes in. You have Marvel Entertainment and Marvel Studios and all-encompassing assets. You have the Fox Entertainment Group, which they bought in 2019, which includes 20th Century Fox, FX Network Groups, National Geographic Partners, Fox Sports. Down here you have Pixar, Lucasfilms, which is of course the Star Wars franchise. You have Disney Media Group, Disney Theatrical Group, Disney Parks, Experiences, and Consumer Products that include all of Disney Publishing, Disney Games, Disney Resorts, Disney Cruises, other media arms like ABC Entertainment Group. Disney controls a lot of the news media. A&E Networks, which includes the History Channel, Vice, Lifetime. Outside of that, you have Disney Channel, of course, Radio Disney. Outside of that, they're also sort of a real estate holding company with all the massive amounts of real estate that they have to have for their parks and resorts, as well as for future planned development. They also have substantial growth segments with a huge majority stake ownership in Hulu. They own 60% of Hulu streaming. They've taken some strategic investments in many early stage companies like GoPro. I don't know if that's been that big of a plus for their bottom line, but hey, they have concentration all over the world in a lot of these early stagers. They of course also have ESPN. They have a 80% majority stake in that as well. With Disney, you have a very interesting combination of the safety of the old guard, the traditional revenue streams in entertainment, with the aggressive growth of the new guard. You look at the earnings per share growth that the average analyst is expecting, sourced from Seeking Alpha. They are expecting us to see incredible acceleration for the next few quarters. And I think that with these earnings boosts and a lot of their revenue streams coming back into play, they're going to do very, very well in 2022. Next, we have Visa. So about a year ago, I highlighted stocks that I felt had a lot of opportunity as we started reopening, and credit cards were amongst the top of my list. And Visa had a strong start earlier this year, rallying up to 252, but Visa had once again fell into a downtrend and basically wiped away all of its pandemic-era gains as well. Mostly flat on a year-to-date basis despite record inflationary pressures, increasing the cost of things and in theory, giving inflated fees to Visa. But here's the thing, one of my favorite business models in the world really is the payment processing business model. A business that simply charges a fee for transacting a simple customer purchase. Love it, love the business model, but not all of them are created equal. Some you have actually going and lending the money, others just serve as a secondary type of middleman that doesn't even lend the money, but instead what do? They go and partner with financial firms to do so for them. For example, you have Uber wanting to offer a credit card. Who do they turn to? Well, Visa alongside whatever bank they chose to do this with. I think it was Chase. You want to buy overpriced clothes? Well, Nordstrom and Visa will help you. You want to earn airline miles? United and Visa have got your back for that Mexico trip. Bring Charlie back some tacos and some quesaritos. I don't know if quesaritos are actually real authentic Mexican food, but I have gotten that before at Taco Bell, so it must be. But more importantly, Visa is arguably the #1 player for big banks. Banks that offer Visa partnered cards, and usually the majority of their cards are Visa, are Bank of America, Barclays, Capital One, Chase, Citi, and so forth. Visa is arguably the first and foremost company that people go to, corporations go to, banks and consumer goods sellers go to when they want a partner for a card. So anyways, I would argue with Visa, you get both mandatory and discretionary consumer spending exposure, relative inflation protection, because as costs are rising and consumer spending is rising to meet those costs, what also rises? Well, fees. You also get a horse in the stable of many different fintech companies that are going and trying to compete in this big fintech payment processing space. In terms of growth potential into new trends, Visa recognizes the headwinds of cryptocurrency emergence, and they've partnered with 60 crypto platforms to let consumers spend digital currency at millions of merchants. They're also very, very aggressive with share buybacks, so I think that Visa is a very solid bet heading into 2022. All right, now let's get into our first growth stock, Upstart. Here's the deal. We presented on Upstart and reiterated it as a buy at about the $90 range earlier this year. It's had a lot of periods of FUD in favor, and it had a massive, well-known period of favor when it ran up all the way to $400 before then tanking. The market factored in far too much, far too quickly, and that's something that we said at the time when we were covering it. But hey, we know that the market loves to shift from overly optimistic to overly pessimistic, and it's always good to buy from pessimists and sell to optimists. What does Upstart do? Well, Upstart offers an automated lending platform that takes a significantly deeper look at each applicant. The premise of Upstart is that traditional lending platforms don't look at the full rounded picture of the applicants and thus don't get an accurate risk assessment. By looking at just a few variables identified by a FICO score or a traditional credit score, you're missing out of 1,000 plus other variables like education, cost of living in the area that the applicant is living in, work record, so on and so forth. All things that should be very, very relevant to an applicant's ability to pay. By using a ton more variables and a automated AI platform, what happens? Doing that gives you a better and more accurate risk assessment, which means, hey, you could deny people who are more likely to default, or you can give them a cheaper rate if they're very, very unlikely to default and approve them at a higher rate than maybe they would have qualified for under a traditional credit score. You get lower premiums for lower risk borrowers, and you get to avoid higher risk borrowers or give them a more accurately higher priced premium. How has that worked so far? Well, Upstart reports that for personal loans, their rates are 10% lower than traditional lenders. They have 75% fewer defaults at the same approval rate, and were 5 times more predictive than credit scores during COVID-19. And had industry-leading survey ratings amongst borrowers. Now, in terms of proof of concept, revenue is up 250% year over year. Number of loans is on a steady uptrend as well. Since IPO at the end of last year, they've more than tripled their profits, tripled their revenue, and tripled the number of banks and credit unions that are on their platform. And heading into 2022, the cost of everything is going up, from cars to houses to just consumer goods. And you have more and more demand for taking out debt. At the same time, you're going to have rising interest rates, which aren't going to go up dramatically next year, but they will go up. But the more that interest rates go up, the more important an accurate risk assessment is going to be. It may not matter if interest rates are at all-time lows. You're like, yeah, whatever, that's a fine interest rate. But if all of a sudden interest rates are going up and up and up and up, then you're like, well, I need to make sure I have the best one possible. And the banks and lending institutions that are willing to use a platform like Upstart are going to be able to provide that. Number 4, Chargepoint. So this is a stock that is no surprise to any of you, and it's one that we've talked about substantially on the channel. We just talked recently about how I bought the dip on this one because it's at these historic 52-week lows. Chargepoint is special though because the business model, simply selling hardware and then the software subscriptions on said hardware. And because it's the #1 provider, you have all of these people that just bought hardware and they're now locked into monthly subscriptions with Chargepoint. Chargepoint doesn't have to buy costly land. Chargepoint doesn't have to worry about people wanting to charge at the stations because, again, they're just selling the hardware and the software. And the way that I see it with this is very, very simple. As more EVs are adopted, you're going to need, well, more EV charging stations. Especially in metropolitan areas where people don't have their own garage, you're going to need Chargepoint to go and build a residential charging station in an apartment building where you have a lot of residents that are like, hey, I'd be willing to pay more rent if you had a damn EV charging station for my vehicle. But anyways, why is it so cheap right now? Well, the administration has promised to help build 500,000 charging stations, but their Build Back Better plan was recently put on ice. That bill would have provided $5 billion in formula funding to states with a goal to build a national charging network, which would have been the largest ever U.S. investment in charging infrastructure and would have definitely got the ball rolling a little bit faster. And Chargepoint, who is the #1 EV station provider, would be presumably one of the biggest beneficiaries of this bill. But the way that I see it is that was just icing on the cake. Demand for EV charging stations is going to increase as demand for EVs increase. And that's just simply the way that I see it, and Chargepoint is going to be the biggest beneficiary of that. I see the loss of confidence in EV charging stations because of the loss of this bill as a huge inefficiency. Okay, lastly, Alphabet. So of the big tech companies, Alphabet is my favorite. I know it's not exactly an underdog, and I just made a video talking about how stocks like Apple are charging unprecedented amounts of money for what you're getting company-wise. But Alphabet is a beast, quite simply. You have Android, which controls 54.4% of the market share for mobile operating systems in the US and 72% globally. You look at the most popular visited websites worldwide, what are the top two? Google.com and YouTube.com. Obviously, YouTube is owned by Google, which is owned by Alphabet. But most importantly, despite how fast Google has gone up, one should still be very, very bullish on this company. Why? Nearly 2/3 of all ad spending is now digital, and that's going to keep growing substantially. And who benefits from that? Well, Google with the majority share of this. Haven Investments research shows that Google is not just controlling the biggest share of the digital ad market already, but it is poised to take over 50% of the market by 2023. And so a lot of that expansion is going to end up going to Google. Ads make up the vast majority of Alphabet's revenue streams as is. Ads from Google Search, YouTube ads, and the overall Google network coming out to $53 billion last quarter. Well, if you're bullish on ads, you gotta also be very, very bullish on Alphabet and their growth potential. A little bit of adception, but if you watched an ad on this video, hey, Google gets 45% of the revenue from that ad. And they certainly have some other segments that are quickly growing, like Google Cloud, which must be mentioned. But overall, this right now is, for all intents and purposes, an advertisement play with some strategic diversification outside of that. Sounds funny calling Alphabet a advertising play, but that's really what it is. Those who control the data control the world, and Google is the first to know about every single consumer trend, every single economic transition. They're the first to know what demographics of people buy what and when they do it. They know where they do it too. This is something that's extremely valuable to advertisers, but they also own a lot of the platforms that these consumers are on in the first place. So you have just this very, very well-rounded business model. In 2022, you're going to be in this environment where a lot of advertisers are going to compete for less consumer discretionary money. The more money that businesses have to spend to get consumers to convert, well, that's going to be more money for the bottom line of Alphabet. So I'm very, very bullish on Alphabet moving into 2022. In terms of some of the other runner-ups from this list, I was definitely thinking about PLTR or NEO or Lucid, but keep in mind that these are stocks that you have to check on conviction-wise, quarter over quarter. If Lucid has two bad quarterly reports and their deliveries just don't make any sense for what we thought was possible, then you have to be able to downgrade the price target. You can't just buy, hold, and forget about it because they're just so early stage of a company. With NEO, it's not as early stage, but you also have that problem of like, well, you are in China. You have to monitor the situation there. You can't just buy, hold, and forget about it. And this is a buy, hold, and forget about video. There's also Tesla, which obviously I'm a huge Tesla fanboy. That one is a very, very strong long-term conviction play of mine. But the problem with that one is that you're factoring in so much future that you're already at the 7th most valuable company in the world. And at this point, I just don't think that that needs more plugging as a good buy and hold play. I think that with Tesla, if you see it sell off a lot more, if you see it go not just 900 like we saw recently, but maybe 700, then you're like, okay, well, you're getting a decent deal if you hold it for long enough. But when you have a company that's gone up so much and is doing very well, but has a lot to earn, you want to make sure that you're getting some risk premium discount, because other than that, you're paying for somebody else's risk premium discount, and that's what a lot of people do with Tesla. But anyways, folks, that caps off this video. Let me know what you think about these picks. What are your picks for 2022? Let me know below. If you'd like to join us on ZipTrader U, we do have coupon code HOLIDAY25, which will get you a discount. We did raise the price after the Black Friday sale, but if you do want to get in on our lifetime access for the daily morning briefings, our step-by-step lessons, and the private chat, I'll go ahead and put a link to that below. If you're wondering what broker to trade these stocks on, well, Webull does give 5 free stocks when you sign up and deposit with our link below. Yep, that's 5 free stocks, sign up, deposit any amount. Anyways, have a good one, and I'll see you in the next video.